Most people believe a bank account cannot suddenly stop working. The balance is visible. The app opens normally. The card worked yesterday, so the assumption feels safe. As long as the money is still there, access must be guaranteed. But in modern banking, the balance is not what determines access. The system is. And sometimes the system stops without warning. No alert beforehand. No public announcement. No visible crisis. Just a message. Account restricted. Access temporarily suspended. Funds under review. The money still exists, but the system has frozen it. If the funds belong to you, why can the account be frozen at all? If the balance is real, why can it become unusable overnight? And if ownership means control, why does someone else hold the authority to stop it? These questions rarely appear when banking works normally. Most people interact with financial systems through routine. Paychecks arrive, cards swipe, transfers complete. Everything feels stable. But the stability people experience is not the same thing as control. Modern banking systems operate on a structure that is both highly efficient and highly conditional. The digital infrastructure that allows money to move instantly also allows institutions to stop it instantly. That ability is not an emergency measure. It is part of the design. To understand why accounts can be frozen without warning, it helps to begin with a fact that contradicts how most people think about their bank balance. The money in a bank account is not technically stored for you. When funds are deposited into a bank, legal ownership of those funds transfers to the institution. In return, the bank records a liability equal to the amount deposited. Your account balance reflects the bank's obligation to repay you. The balance represents a promise, not custody. The bank is free to use the deposited funds as part of its operations. Those funds support loans, financial markets, and liquidity management across the broader economy. This arrangement is the foundation of modern banking. It allows the financial system to expand credit and support economic activity far beyond the amount of physical currency in circulation. But it also means deposits exist inside institutional systems rather than outside them. Your money does not sit idle waiting to be withdrawn. It circulates within a network. And that network is governed by rules. Those rules are not always visible when the system functions normally. But they become clear the moment access stops. Freezing an account does not require a crisis. In fact, account freezes happen every day. Banks freeze accounts when fraud is suspected. They freeze accounts when transactions trigger regulatory alerts. They freeze accounts when compliance systems detect activity that requires investigation. Sometimes the freeze lasts hours. Sometimes it lasts weeks. During that time, the account still exists. The balance remains unchanged, but the ability to use the money disappears. From the perspective of the financial institution, this is not extraordinary. It is routine risk management. Banks operate under extensive regulatory frameworks designed to prevent financial crime and protect the stability of the system. These regulations require institutions to monitor transactions continuously. Every payment is evaluated. Every transfer is analyzed. Every account activity interacts with monitoring systems that scan for irregularities. Most of the time, nothing unusual appears. The system allows the transaction to proceed. But if certain patterns are detected, the system intervenes. The intervention can be immediate. A transaction is declined, a transfer is delayed, an account is frozen. The reason may involve fraud detection algorithms, anti-money laundering rules, sanctions screening, or internal risk controls. From the institution's perspective, freezing the account is a precaution. From the account holder's perspective, it feels like control has vanished. The key point is that the freeze does not remove the money, it removes access. This distinction reveals something deeper about how modern finance works. Access to money is mediated by institutions. Those institutions operate the infrastructure through which digital balances move. Payment networks, clearing systems, regulatory monitoring tools, and banking software all participate in evaluating financial activity. When everything appears normal, the system functions automatically. But the authority to intervene remains present at every moment. And when it activates, it can do so instantly. The structure becomes clearer when examining how digital transactions actually occur. When a payment is made with a debit card, the process involves several institutions communicating within seconds. The merchant's bank sends a request to a payment network. The network contacts the issuing bank. The issuing bank evaluates the request and decides whether to approve the transaction. If the bank approves, the payment completes. If the bank denies it, the transaction stops. The system does not ask the account holder for permission. It evaluates the transaction according to its own rules. Those rules exist to manage risk across the financial system. Risk management requires authority. Authority includes the ability to deny transactions, and if necessary, the ability to suspend accounts entirely. The same principle applies to bank transfers. A digital transfer may appear as a direct movement between two accounts, but the process often involves multiple financial institutions. Each institution must verify compliance. If any step in that chain identifies a concern, the transfer can be halted. The funds remain in the originating account, but the account may be placed under review. During that review, access may be restricted. The freeze becomes visible. What often surprises account holders is the speed at which this can happen. The systems monitoring financial activity operate automatically. Machine learning algorithms evaluate transaction patterns across millions of accounts. When the algorithm identifies unusual behavior, it triggers an alert. The system may then suspend activity. This automation allows banks to respond quickly. But it also means decisions occur without human explanation. A freeze can appear instantly. No warning, no discussion, just a notification. The reason may involve a large transfer outside typical spending patterns, or an international transaction, or a payment involving a flagged merchant category. From the outside, the cause may be unclear, but the outcome is the same. The account stops functioning. The deeper issue is not the specific trigger. It is the authority that allows the system to intervene in the first place. Financial institutions possess that authority because the entire banking system is designed to prioritize stability over unrestricted access. If banks were unable to freeze suspicious accounts, they would struggle to comply with financial regulations. If they could not pause transactions, fraud and illegal financial flows would be far more difficult to control. The ability to freeze accounts protects the system, but it also reveals the hierarchy embedded within it. Banks operate the infrastructure. Individuals use it. That difference matters, because the operator of a system always retains the ability to intervene. As financial systems have become more digital, this dynamic has intensified. Decades ago, physical cash provided an alternative method of holding money outside the banking network. A person could withdraw funds and store them independently of institutional oversight. Digital payments have gradually replaced that possibility. Most economic activity now occurs through bank accounts. Each of these systems operates through centralized infrastructure. Centralized infrastructure concentrates authority. It allows institutions to monitor and control financial flows in ways that were not possible in earlier eras. That control rarely appears in everyday transactions, but it becomes visible in moments of interruption. A freeze exposes the boundary between personal expectation and institutional authority. The account holder expects ownership. The system enforces conditions. These conditions are often written into agreements people rarely read when opening accounts. Bank contracts typically include provisions allowing institutions to suspend accounts if suspicious activity occurs. The language may seem technical, but its implications are simple. The institution retains the right to pause the account. That pause can occur immediately, without warning, and sometimes without immediate explanation. This is not necessarily evidence of systemic failure. In many cases, it is evidence of the system working as designed. Financial networks must maintain the ability to intervene quickly to manage risk across millions of transactions. But the presence of that ability changes the nature of financial control. A bank account may appear to represent direct ownership of funds. Yet the ability to freeze the account demonstrates that ownership is conditional. Conditional on rules, conditional on compliance, conditional on institutional approval. Most of the time, these conditions remain invisible. The system functions smoothly, but the architecture behind the system does not disappear simply because it is not visible. The monitoring systems remain active. The compliance frameworks remain in force. The authority to intervene remains embedded in the infrastructure. And when that authority appears, it does not usually arrive with dramatic signals. It appears quietly. A declined transaction, a restricted account, a frozen balance. The money remains in place, but the system has paused its movement. Once that moment occurs, the structure of modern banking becomes easier to see. The account is not simply a container holding money. It is a position within a network governed by institutional rules. Those rules define when the account functions and when it stops. Most of the time, the system allows access to continue without interruption. But the moment an account freezes reveals something that was always true. The control over the account never fully belonged to the person whose name was on it. It belonged to the system that allows the account to exist in the first place. And that system can pause it whenever the rules require. Sometimes without warning.